Since 1987, we've helped investors navigate the markets using technical research focused on relative strength, supply and demand, and momentum. From sector rotation to asset class rankings, we highlight what drives performance. Nasdaq, Dorsey, Wright, helping you stay one step ahead.
Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week of July 1st. We're recording this here July 1st. You got Ian Saunders here, and I'm lucky to be joined today by John Lewis. John, good to see you this week. Happy almost 4th of July.
Yeah, almost 4th of July. We got the World Cup going. There's all sorts of stuff going on. What a week.
Yeah, it is. What a week. Definitely a lot of fun stuff going on. A little bit slimmer in, I would say, a lot more out of office responses when I'm sending emails this week. So we'll have this podcast out. We're talking about something that's a little more evergreen this week, though, when we're talking about. So John, for those who might not be familiar, I'll give you a real brief intro here. He's a senior portfolio manager for Nasdaq Dorsey Wright, one of the co-heads of the business, based out of Pasadena, California. John runs most of the managed account strategies that we have and builds a lot of the strategies that we have that track some of the various index products that we have with some of our partners. So we're going to actually be diving into a few of those today. But maybe, John, before we dive into that, I won't ask you about your World Cup predictions.
Yeah.
Maybe we can save that till the end of the podcast. But just from the broader state of market action, I mean, it was a pretty good. We just wrapped up the second quarter yesterday. Pretty good second quarter. One of the better second quarters that we'd seen in the past 5 years. I think I saw, for at least on the domestic equity front.
Yeah, it's been a while since we've had a half or a quarter that good. And it when we look at it, like, the leaders are leading, the laggards are lagging. That's very good. But also, I think what's more important is that we're seeing the market consistently push to new highs. So we'll push to new highs, get a pullback, push to new highs again. There's all sorts of supposed bad news out there. The market doesn't seem to care. And I think that it's really important that we just keep going with this trend until we see that the market is unable to continue to push to new highs. So that's going to be really important to watch over the summer and into the fall. And I think too, and Ian, we've been talking about this on the morning call and in the daily equity report and things like that. The market is becoming much more narrow in terms of what is the leadership, and we've seen kind of a drop off, and we're not seeing the indicators necessarily pushing to new highs like we are the overall market. So that's kind of the fly in the ointment right now, but that doesn't mean that the market has to turn around and fall apart. It's just getting narrower and narrower as this bull market matures.
Right, that makes sense. I mean, some of the indicators like you're talking about, we look at a lot of those participation indicators, right? So the percentage of stocks looking at upwards movement. When you think about that and maybe how it applies to momentum, if we have a narrowing market, is that better or worse for momentum or trend following strategies?
So while it's happening, it's fine for momentum strategy because the market continues to narrow. And as long as you have a fairly concentrated momentum strategy, you can focus on on what's working and then just totally exclude what's not working. The problem is that can't go on forever, right? And so it does start to signal like the maturation of the bull market when you start to see this narrowing. But while it's going on, and it can go on a lot longer than people think, momentum strategies usually do very well in that type of environment.
Right. And I mean, to your point, going on longer than people think. I mean, we've had quite a run from some areas recently on the domestic equity front, looking at like semiconductors, for example, right? I mean, it's been, I feel like every week it's a new semiconductor stock that's up 100%. It's kind of crazy these days. In market environments like that, it's not the first time we've seen, maybe the first time we've seen it for semiconductors, but we've seen other runs in the past. And you brought up the point on maybe even previous podcasts that these runs, people might think they're over, but they might stick around for a little while potentially.
Yeah, absolutely. Because what's happening is like you've got a small subset of stocks that are working and stuff that's not working. Portfolio managers are continually like shedding those stocks for whatever reason. And they've got to put that money somewhere, right? They've got to, generally speaking, they have to deploy that cash. There's not a lot of PMs that sit around with a ton of cash. And so they kind of go to what's working, and that list is kind of getting smaller and smaller. think the second thing that happens as well is a lot of these like leveraged hedge fund strategies or things like that, like they do kind of focus on these areas where they can get the returns now. Like I don't know of a lot of these leveraged strategies that like sit around and wait for a value story to come around over the next 3 years, right? Like they've borrowed the money, they need the returns now to do all that. So there's a lot going on, and that list kind of gets narrower and narrower, and the money just keeps kind of piling in to this small subset of stock.
And so when we're looking at piling money into areas, I mean, we track a lot of different things across various indicators and whatnot. One of those being the RS spread, which is something that I believe you update there on the platform. I mean, that's kind of our gauge for the state of the momentum market, as it were, if I'm not mistaken. What is that indicator, and kind of what has it shown us so far this year?
Yeah, so the RS spread just measures a basket of high momentum stocks versus low momentum stocks. And we've got it out there on the front page of the Research Hub. We think it really does kind of show the overall health of the momentum market. What we're doing every month is we take the top 20% in terms of momentum and the bottom 20% in terms of momentum. Every day, we compare the performance of those two baskets versus one another, and then we just plot that over time as a return stream. So when the spread is rising, right, that's the kind of environment we like to see. The leaders are outperforming the laggards. That's good for momentum. And you can see, especially this year, we've seen that spread kind of keep pushing to new highs. That's really, really important. We've had a pullback here more recently, but this is just like a pullback and a larger uptrend, at least at this point. So momentum remains very healthy. This is a good environment for momentum strategies. And we're seeing that across the board, especially in the large cap space. It's not as powerful in the small cap space right now, but it's not terrible either.
Right. So when we're looking at taking advantage of some of these different momentum markets, right? Mentioned we're going to talk about some of the products. So we have a variety of products with Invesco that look at they're called a technical leaders suite of products, right? I believe it's what, John? It's looking at 2 broad U.S., 2 international, and then 9 sectors to kind
Yes.
of round out the suite.
Yeah.
So we're going to be talking about the 2 broad U.S. and the 2 international ones today. So you mentioned we've seen some improvement on the large mid space. That product, I believe, is looking at PDP. And so just go ahead and get the name here, the Invesco Dorsey Wright Momentum ETF. So maybe give us a few seconds there about what is the strategy behind that product, what's it kind of looking at there, and it's been around for a while, right?
Yeah, so it's been around since March 1st of 2007. So we've been running this. We're coming up on, it'll be 20 years next year, which is a pretty big milestone. It's very simple how we run the strategy. We take a universe of mid and large cap stocks. So we use the Nasdaq U.S. Mid Large Index, which is very similar to like the Russell 1000. A few more stocks than like the S&P 900. So it's, there's about 950 names in there. So large and mid cap stocks. Every quarter we go through and we rank every stock in there based on a momentum score. Um, since it's roughly 1,000 stocks in the universe, we're looking at taking the top 10% out of there. So each quarter we'll go through, and the 100 strongest momentum names we'll put into the strategy, and then we weight them by their momentum score. So it's not equal weighted and it's not cap weighted. I think the cap weighting has hurt, especially in this area over the last couple of years, but this year it's been fine because a lot of those big mega cap mag 7 names haven't been performing as well. There's been some better performance a little bit down the cap range. So we've seen some better performance this year versus some other years where you just had to have so much invested in those mag 7 names, which if you're kind of doing it by the overall factor weight instead of market cap weight, that's very difficult to do. So each quarter, that list is completely refreshed, rebalanced, and then we hold those names for a quarter, and every quarter we're just repeating that same process over and over again.
And so when we look at that momentum score, right? I mean, we're not the only people with momentum strategy out there, right? How does this momentum approach maybe differ from some other momentum approaches out there?
Yeah, I mean, there's a number of different ways to calculate momentum. We tend to favor using the point and figure approach, and so what we're doing. If you've seen a lot of our research, for example, that we know that the stocks that are in a buy and X on their momentum chart, right? That's the kind of the best configuration. That's the basket that outperforms over time. So these stocks at least have to be in a buy and an X versus the broad market, and then we kind of do the scoring from there. And essentially, what we like in our momentum score is we like stocks that have continued to appreciate and are not super volatile, right? We like that chart to just kind of grind higher. It doesn't mean that it's in a column of X's going all the way up. It can go from a column of X's to O's and back to X's again, but we don't like to see sell signals come in there. We like to see it really grind higher over a long period of time.
So it's point and figure based. It's not just using the classic 12 minus 1, right? Which kind of separates it a little bit. And we see some different exposure between, at least historically, between this momentum approach and maybe your other more classic 12 minus 1 perspective, right? Just different ways of evaluating there. So when we're thinking about the kind of methodology, how do you see most people using this within a portfolio?
Yeah, so momentum is a really great tool to use in an overall portfolio context. So you can do a couple of things with these ETFs, right? You can have them in kind of like a factor rotation type of strategy or things like that. When momentum's going well, you can just kind of put it in as a satellite piece and get a little more exposure and add on to some other momentum or whatever strategies you might have kind of running as a core. You can also use it as a core piece of an overall client allocation. So momentum mixes very well with value, low volatility, and high dividend names. So um, the excess returns are negatively correlated. That's just a fancy way of saying when momentum does well, those other strategies tend not to do well, and vice versa. Right. So it mixes well with those type of things. And then on the ETF side, the tax efficiency is very good because of the exchange process, the create redeem process, and things like that. So when we have to make all these changes every quarter, we're not constantly generating these realized capital gains that you have to pay as you go along. A lot of that is taken care of through through the exchange process that ETFs use to make them tax advantage. So for momentum strategies, ETFs are actually a really good wrapper.
No, that makes sense. But when we're looking at it from, as you've had a slide up in presentations I've seen in the past that looks at kind of where the outperformance, potential outperformance historically within a strategy like this comes from. I mean, you're going to see changes within these portfolios over time, right? And some quarters see more changes than others. But it's kind of those long tail winners that are typically the at least give you a lot of the return within the portfolio.
That's where, yeah, all of these kind of systematic trend following strategies, that's the way they work. So you're getting the bulk of your returns from a smaller number of the trades. It's those stocks that we hold in there for years and they just continue to grind higher, grind higher, grind higher. The majority of the trades that we do in all of these strategies, they come in, they go out, you hold them maybe one, two, maybe 3 quarters. They're not really additive to performance. They don't really detract a ton either. They're more kind of like market performers, and they're just not strong enough to stay in the index. So they come out, we replace them with something else. There's nothing bad about that. That's, just us doing that old Peter Lynch adage, right? Of watering the flowers and pulling the weeds, holding the winners, cutting the losers short. That's what these strategies are designed to do. Since this is an index, it's totally mechanical and things come and go. Like we're not sitting around kind of deciding what should go into the index. It's a very kind of systematic and quantitative process that we undertake when we go about and reconstitute and rebalance all of these indexes.
Right, and that's I mean that's important, right? The objectivity. You never everyone has a gut feeling about the market action, but you kind of let the system do it for you, right?
Was just going to say, when people have gut feelings about things or they know something specific about one stock or something like that's fine. And I totally understand. Like, you can on any one stock or any one trade, you can maybe do better on that than we can do with an overall system. But we're talking about trying to do like a bunch of trades over 20 years, right? Like having us be right on our emotions and our gut feeling is going to be really tough to do that on a consistent basis. So, yeah, I mean, to us, like the individual names that come and go are very interesting, but they're not as important as keeping the overall profile in that kind of high momentum area. That's what's super important for our long-term success.
That makes sense. That makes sense. But when we're looking at some of the individual names, we did just see an evaluation for this because it's
Yeah.
evaluated quarterly. So we just saw some changes that have taken place right at the beginning of Q3. We actually did a little piece on this on the Research Hub that's on the Nasdaq Dorsey Wright platform. So I'll go ahead and bring this up here now. We saw 53 changes, if I had that track correctly, which is a little over half the portfolio, right? It's a little more than we saw in the prior quarter, with some interesting names kind of coming in and out. At least guess certainly from a sector perspective, technology, the biggest improver there, getting 42% of the new additions. What do you think that kind of, I mean, obviously everyone is, we've seen technology rise in the rankings. We've seen it come into other models. What do you think that kind of says about the market action for this latest update?
Yeah, I mean, we definitely are kind of rotating more into tech. And we've seen that in a number of different strategies, not just our indexes, but other strategies that we run here. What's happening, and we talked about this at the start, things are getting very narrow, right? So these areas that we might not own the stock for whatever reason, like they're starting to come in because that's really all that's working. And so as the market kind of continues to narrow and the number of names that are really performing well continue to dwindle, I think we're going to see this same kind of action. And turnover, I would expect, would probably be a little more than normal as long as this kind of continues. But again, that's not terrible for an ETF strategy because of the tax advantages afforded to that by the ETF wrapper.
Right. When we're looking at some of the other sectors too, I mean, I do see industrials pop up a lot here, both on the adds and the deletes. I think when you're looking at it, we saw 21% of the names that were added were from industrials, and then 28% of the names that were removed were from industrials. So a lot of rotation within the sector itself. Is that typical?
So it's not typical, but it happens more over time, like in industrials and also something like consumer discretionary. Consumer discretionary hasn't been as good, so we haven't seen that as represented in the strategy as we have in the past. But industrial specifically, right? There's certain industrial names that are doing very, very well. Right. So those are the things related to the AI build out, which are essentially like electronics names. And also you get some like heavy construction names or HVAC or generators, like things like that. Those are all doing really well. There's a bunch of industrial names that are not doing well. And some of those might be like industrial services, which are really under pressure because of the potential, AI implications and the AI kind of taking over what those companies do. And we've seen that even in technology where software is not doing well at all. And I think that's a big worry that AI can kind of take over a lot of that. But semiconductors and like some of the comm services stuff and things like that are doing great. And so there's been a bifurcation in a lot of these sectors. And we're definitely seeing that, especially like you mentioned, Ian, with in industrials where it's kind of like as many are coming out as are going in, and it's a pretty large number.
Thank you, John. And when we're looking here too, I mean, we have the updates to PDP. We also wanted to dive into the updates for the small cap side of things. I think it's maybe apt when you see another article we had a few days ago, small cap sizzle, right? So we've seen some areas in the small cap space have started to sizzle a little bit. I guess when looking at that fund, the Investor Dorsey Wright Small Cap Momentum ETF, similar approach to PDP, just looking at the small caps, looking at a few more names. Is that right?
Yeah, exactly. So, in PDP, we're taking the top 10% right out of that 1,000 universe. And then on small cap, we're taking the top 10%, but it's like a 2,000 stock universe. So we're taking 200 names. And I think that's pretty prudent considering small caps are generally a lot more volatile than their large cap names. So that does help kind of reduce some of the single stock risk that we see by just spreading the bets out over a larger number of names.
That makes sense. And when we're looking at the momentum approach within small caps, I mean, how do you usually, we talked a lot like the R spread, a lot of the stuff that we talked about has been in that large mid space so far. How do you see that playing out in the small cap space? Because small cap cycles are different, right?
Yeah, exactly. So if you follow kind of what we write about on the RS spread stuff, the small cap RS spread has not been as strong as the large cap one. But we've been able to find some good names in there. So performance and stuff has been good this year. It's been solid, but it hasn't seen the same type of outperformance versus the benchmark that we have like on the large cap side. But still, it's a good momentum market, and our stuff and momentum stuff in there continues to perform well. So we saw a lot of changes, a lot of turnover, just like we did on the large cap side. So yeah, I mean, things are going kind of as expected, and I'd like to see, the leaders kind of really start to assert themselves as we go through the rest of the year.
Right. And when we look at some of those leaders within the small cap space, I think the biggest sector addition was healthcare. Seemed like a lot of biotech stuff coming in there. When that stuff gets on a run, I know it can go pretty quick.
Yeah, and in the small cap area, you do get a lot of that. You get a lot of these healthcare names. You get a lot of financial names as well. We obviously haven't been as big on financials in this because that's just really not where the momentum is at right now. So it is in the more speculative kind of healthcare names, and they're always interesting. And in a strategy like this where you have a bunch of them in there, you're going to get some of them that fall apart, but you're going to get some big winners too. And we've definitely seen that, over the past couple years. So the healthcare space is like, I think, a really, really good. Um, it's a good area for a momentum strategy as long as you spread the bets out a little bit and you're willing to take some hits in order to get the big winners.
Right, right. And one of the other things I think is interesting, we have a little piece in this. This is also a part of the quarterly update there. But one tidbit that's different with the small cap space versus the large cap space is sometimes you get some removals from the small cap simply because they got too big, right? By nature of the index. I mean, that could be possible, but kind of graduates from being a small cap. Obviously, we'd have to kick it out of the portfolio, right?
Yeah, exactly. Because we use the Nasdaq U.S. Small Cap Index for this, and they reconstitute those indexes like twice a year. So twice a year, when we go through, we might see some of those small cap names have done so well that they graduate into the large cap space, and the reverse is true as well. Like we see some of the stuff falling out of the large cap space into the small cap space. Those generally don't get picked up in our stuff because we're looking at strength. But we do definitely pick those things up that go into the large cap space.
Right, right. That makes sense. Great. Well, when we're looking outside of the U.S. equity side of things, we've looked at the large mid, we've looked at the small caps, but it's been a great year for international equities, right? I mean, we still see international equities at the top of our broad asset class rankings, and particularly over the past quarter in Q2, a lot more strength for emerging markets versus developed markets, right? Are you seeing the same thing?
Yeah, so emerging markets has really picked up, and just when we look at kind of the broad market, I think developed was really good until about this time last year, give or take, and then emerging kind of really took over. So emerging, we've seen really come to the fore. Our emerging market allocation, like we are really, really heavy in Taiwan. That's probably not a huge shocker to everybody. We don't have country caps on these. We let them swing around, and Taiwan is full of these semiconductor makers, and especially a ton of like industrial, specifically like electronics manufacturing and things like that. So we have a really, really large weight in Taiwan, and I think that's a pretty good spot to be, considering how the whole kind of AI trade is unfolding.
Right. So this is with the Investor Dorsey Wright Emerging Markets Momentum ETF, PIE. I think we mentioned it a little bit earlier on, but that's looking at similar kind of approach, right? That's its technical leaders framework, but just looking at a basket of emerging market names there.
Yeah, absolutely. And so it's the top 1,000 market cap names out of the Nasdaq Emerging Market Index. We're taking 100 of them. We use the same scoring system for that as we do on PDP and on DWAS. And so we haven't like optimized these to one specific region or anything like that. Momentum is robust enough that we can use the same model on these different universes. And so it is funny, if we have one of these ETFs that's kind of lagging in the suite. It's not like anything with the model. It's just that either kind of we're out of sync in that region, or there's something going on in emerging markets or developed markets where it's just not a good momentum market, but maybe others are. And so that's, I think, been really interesting over the years to watch that and kind of how that stuff unfolds over time.
Right, right. And with the other side of the coin on the emerging markets, looking at the developed market side, so the Invesco Dorsey Rate Developed Markets Momentum ETF PIZ, within those, I mean, we've seen some different movement from momentum within the developed and the emerging market space. Developed has been pretty consistent, but maybe not as seen as much rapid improvement. Is that because it's not as focused, maybe, as some of the focusing on some of the strength is a little broader strength in the developed space, or what are you kind of seeing there?
Yeah, I think that's probably right. And our domestic momentum indicators have been good for a while. The performance on that ETF has been very, very good. And so I think it's just been a little bit broader, and I think it's been a little less volatile and a little less concentrated in the AI trade. Emerging markets, we've just seen that kind of rapid ramp up in like a lot of these little electronics firms and things like that. But look, that's what's working. And we know we've done this momentum stuff for long enough at Dorsey Wright. Everyone that works here knows, like, when there's a theme out there, you have to capitalize on it because that's what makes the overall momentum trade work. So it's something that, like, we're not super worried about being concentrated in that kind of stuff. That's how this works, and that's where you have to go to get the returns.
And we've seen that within the international space historically. They don't. You've talked about this before. That just there's typically more dispersion within a lot of those areas, right? And so strategy momentum approach is able to maybe capitalize on the winners more. Sometimes avoiding the losers is more helpful.
Yeah, exactly. And there's extra levers to pull on the international side, right? You've got currency stuff going on, you've got different like political things going on where that's not really the case in the US. And so like Europe can be really good and you'll overweight that, and a couple years later Europe might be terrible and Asia might be good, and you're just kind of rotating around to these different areas. So I think momentum works well on the international side. And what we do is also very nice because we're just looking at price for everything. And we're not having to like try to put all of these financial numbers on like the same line, right? You know, because all these countries might have different reporting requirements or whatever. And so using price as kind of the final arbiter makes it very easy to put everything on an apples to apples comparison. And that works really, really well on the international side.
Nice, nice. Final question on the international side: which inventory is South Korea in? Because I know there's some variances out there, some different indices.
Yeah, so yeah, it depends, right? It depends on what index provider you're using. We have it in developed. Other places have it in emerging. You'll just have to kind of look at the ETF you're looking at and make that determination for yourself because some people think it's a developed market, some people think it's emerging market, and the return, like, this doesn't happen very often, but the return this year, because South Korea has been such a great performer, are like totally different if you've got, you know, depending on kind of where you've got it in your suite of indexes. So yeah, check that out. Not just our ETFs, but you know, whenever you're looking at ETFs, find out where, you know, what countries are actually in there.
Perfect. Yeah, important thing to keep in mind. And for more info on any of these stuff, you can definitely reach out to us at dorseyright.nasdaq.com to check out those articles. We'll be sharing around too. I'm sure you can reach out to Invesco. Either of us would be happy to help you out there. So, John, with that, I will. We said we'd save it till the end. What's your World Cup prediction moving forward?
Um, I predict that the U.S. will not win at all. How's that? I'm taking the field.
Are they winning tonight? Are we getting to the
Yes.
next round?
Yeah, we're going to win tonight.
Okay.
We better.
Nice. Awesome. Awesome. There we go. Yeah. Send us into the 4th of July on a good note.
Yeah,
Right?
we need it.
Perfect. All righty. Well, great, John. Thank you very much for hopping on with us this week.
All right. Thanks, bud.